All right. What is going on here? This is on. There we go. All right, cool. Well, so today we're going to be going over the first of. We're going to be doing kind of like a longer segment on Fibonacci. There's a lot to cover on the Fibonacci tools. So this is all sort of building up to something. Okay, so if you guys already know a little bit about Fibonacci or Fibonacci retracement, I still encourage you to watch. We may cover something that you haven't used before, or maybe a level that you haven't used before as well. We're going to start with the Fibonacci retracement, and I'm not going to get into what Fibonacci is and why the levels are important. We're not going to get into that. We're just going to dive into actually using the tool and talking about its use cases, the important levels, things like that. I'm not going to dive into what Fibonacci is. You're welcome to research that on your own, but we're going to just dive right in and start with the tool. And my goal with this is to keep this as brief as possible. So when you guys come to rewatch it, it's not a super long stream, right? You can find what you're looking for right away. So if you guys have questions, ask right away. I'll keep an eye on the chat, and then at the end, if we have some questions, I'll go ahead and take a little bit of time to answer those. Okay. So first things first, go up to indicators, and you would type in Fibonacci, and you would find the Fibonacci retracement tool, right? This seems different. I don't know if they updated. Let's just try retracement. Yeah, they must have done some updating. So I'm not using this one. Mine's a little bit different. I wonder if it's still the same thing technically. Or otherwise you can just go over here and click Fib retracement, right? So it would be the 1, 2, 3rd down, go over to the right. Fib retracement, you can click the star here, add it to your favorites. I have a whole tutorial on how to do these things with trading view, so check that one out. So I'm not going to focus too much on that. So you'd go ahead and click this one, and here's how it works, or at least here's how I learned how to do it. Some people might disagree with me, but how I've learned to do it is you're going to want to draw, and two, you can also use this magnet tool. I actually really like using this magnet tool because then you can get exact levels rather than just estimations, right? So what you would do is you would go ahead and click your Fibonacci tool, and you would draw from left. So you would take a swing low from left to right to a swing high. Okay. And these are my default levels. I don't really use this one at the top here, the 2, 3, 6. I don't use this very often, or I actually hardly at all. But the rest I use quite a bit. So you'd maybe want to keep some of these here in mind and go ahead and mark them on your charts, right? The 382, the 0.5, the 618, added bonus is the 66, the 786, and then the 886. Not a lot of people use the 886 or the 0.66. These two are sort of levels that we'll talk about, later in the stream that I like to have. I mean, ultimately here with the 66 and the 618, it creates a zone, right? Rather than just one specific level, which I like that. Okay, so you can go ahead and mark these on your tool. You just go ahead and click settings, go ahead and adjust these. You can adjust the colors however you like. I personally don't usually have the prices or the levels on here, and I also don't have a background on. I uncheck that one, right? So what does this mean? We drew this from our swing low to our swing high. So what this means is that these areas would be areas of potential support, right? These areas would each be potential areas of support. Now, one thing to note with Fibonacci is that you don't want to rely on these levels alone. Fibonacci is a good source of confluence, right, to other technical analysis, right, like daily, weekly, monthly levels, like the point of control of a range, like kind of like what we had talked about before, right, in the last live stream. So using them as confluences and looking at these areas, because we went from a swing low to a swing high, these would be areas of support. Okay. Now, on the other hand, if we just go ahead and we'll hide some of this stuff, if we were to go from, let's say, the swing high to the swing low on the way up, these would be potential areas of resistance, right? Again, with added confluence. So drawing from left to right, if you go from a swing high to a swing low, this gives you potential resistance zones on the way up. If you draw from a swing low to a swing high, left to right, these will give you potential areas of support. Okay? So that's that, most simply put. And one thing I want to add too is that there are other ways of looking at this too. I kind of use this to gauge, you know, what to expect from price, like to gauge the size of a move. So if price comes down to the 382 and bounces, okay, cool, that's pretty bullish. You know, the 0.5, all right, that's a good retracement to the 618. This is really where I would consider for sure a bounce. If you were to see a larger retracement, you know, a larger retracement down, I would want to see price bounce at the 618 if we were going to see continuation to the upside. Now, if price instead continues lower and flips the 618 to resistance, at that point, I'm not so much looking for a bounce to new highs again as I am looking and saying, you know, are we going to stop, put in a range, or go lower, right? Because once you get to the 786, I'm not really looking for a move higher unless we reclaim the 618 and get a move up, right? And if we get down to the 886, again, I'm not really looking to go higher per se. You know, there are some scenarios that I would look at that, but for the most part, you know, once you get below the 618, you kind of start to think, we might make new lows. It's on the table, right? And the same can be said for the other way around. You know, if you know, in the other case, right, when we got to here, you know, and we blew past the 618, well, you know, new highs is on the table from taking this out, right? The moment that it got past here, now that's on the table. If we can come back down here, flip this area to support, and come back for a continuation, then yeah, you know, it's certainly on the table. But you can see here, where did we reject from is the 886, right? Which is a very interesting level, and is used in a lot of advanced technical analysis with things like harmonics, which we can cover, you know, at a later date. Okay, so that's how to draw them. Left to right, you're making left to right, swing low to swing high, you're making support. Left to right, from swing high to swing low, you're making resistances, right? That's the levels that it gives you. So let's talk about specific levels here. We're going to start with the 382, right? The 382 will be the first level that we're going to start with. So the 382 can give you one of a couple things. I like to use it for flags and also dead cat bounces. So we'll start with flags. When you draw the 382, so here you can see I drew from left to right, right? Left to right. We have our level here. What you would want to see is price retrace to the 382. If price retraces to the 382 and holds the 382, that is classed as a bear flag or a bull flag or a flag in general, right? If price loses the 382, it's no longer classed as a flag. So oftentimes people will they'll take a look at this chart, let's say, and price had a massive move up and it's coming down, and they'll look at this and they'll say, oh, this is a bull flag, and you go ahead and you draw your Fibonacci from bottom to top, and you look and you say, well, actually we're below the 382. This is no longer classed as a flag. Okay, it has to hold the 382 to be classed as a flag at all, right? So in this case here, we hold the 382, and then you look for market structure change, something like this. to break the high, and then you have continuation to the upside. See, so that's how a flag would work. Now, specifically talking about flags, if you have consolidation with a move down like this, creating as an added bonus a falling wedge, which we know is a bullish pattern, right? Well, then that can give us, you know, that gives us a really good setup because we have a high here, and a high here, a falling wedge. Most likely we have bullish divergences. Well, then we can expect a move up, and this is a good bull flag, right? Now, on the other hand, if we're going sideways, this is still a good bull flag, right? We create a channel up here. We create a sideways channel, and ultimately we long the 382. We put a stop loss below the low of the range, and we look to take out the highs and have continuation to the upside. Now, the one scenario that is not a bull flag, oftentimes people will see a formation kind of like this, and they'll call it a bull flag. This is technically not classed as a bull flag, right? Typically, you wouldn't see that sort of correction down to like the 382 zone. You're consolidating upwards. You're creating a rising wedge, which is, as we know, a bearish formation that we would then look out to take out these lows here with then a move back down, right? So this is not what you would want to see in terms of a flag, right? You would want to see consolidation to the downside or sideways, not to the upside. But the thing I want to point out to you guys is you can use the 382 to identify whether or not something is a flag or not. If it breaks below the 382, it's no longer a flag. Okay, I see people constantly misclassing these, right? And we can look, there's a really nice example of a bear flag that we had some time ago. And I'll go ahead and redraw this so you guys can see what I'm doing here. So go ahead and we'll put our magnet tool on. We'll get our retracement tool left to right. So this gives us an area of resistance. And look at how nice this flag was, right? A move down, consolidation, up and into the 382, right? For then continuation to the downside. It's perfect. This actually was a pretty perfect bear flag. You can even see here how it back tested the bottom of the flag, right? Before having its breakdown. You know, this was a perfect bear flag. And another thing I want to talk about too, so again, this class is a bear flag, right? Now, if price broke up and started going like this, it's no longer a flag at all, okay? The 382 is where the line is drawn in the sand when it comes to flags. And another thing too, it's also a place for dead cat bounces, right? So if price breaks down and it fails to break above the 382, well, the 382 is typically the zone that you would look at for a dead cat bounce, which for those of you who might not know is basically saying, well, this isn't a real pump, you know, this is just a sort of a retracement before continuing downwards, right? Or putting in some degree of a range. It's a zone for dead cat bounces. And we can, we'll go like this here. So I drew, and this is all theoretical, right? We haven't gotten this far yet. But we can go ahead and we're going to draw, again, swing high to our swing low of the entire move down. And this gives us our 382, right, at about 36,000, okay? Now, if price were to, you know, let's say come down, break up, get into this range here, put in a period of consolidation, break up to the upside again, get here, and kind of do something like this, well, then this would be classed as a dead cat bounce, right? Which is perfect for bear market rallies in this case, right? Now, that's not to say that this is exactly what's going to happen, but you can draw out this 382, and it'll give you sort of a line in the sand to say, you know, how much higher can we expect? Like, what can we look for here? So again, you know, we get a bounce from the lows and we get sort of this bear market rally. I would look for it to likely extend to, around this zone. I think that the 382 is a very fair place. You can look at other areas of resistance and sort of play it from there, you know. But in terms of this entire move down, the 382 is a fair place, for being a dead cat bounce where you get the move up. It's a bear market rally, and you sort of come back down and range some more. If, we were to break up above the 382 and we were to see some degree of continuation, well, then in that case, I would still be hard pressed to say that this isn't a bear market rally, let's say, but it's an overextended one, right? So you could it's no longer a dead cat bounce, and you could say, well, it's likely that we'll probably go up to the 618 is the next really key area of resistance. And of course, you're going to want other confluences, right? Other forms of confluence to add to that. But if price can break above the 382 and flip it to support, then I would say that the next zone that you would want to look for is sort of that 618 before anything past that, right? So the idea is that you can use the 382 to sort of gauge, whether or not the move is going to have continuation or if it's some degree of a dead cat bounce, right? And we can there's often many examples of this. There are often a lot of examples of this in on lower time frames. Okay, we're not really seeing one there. Let's say when we draw from here to here, so this gave us a swing low. So we have let's go ahead and get rid of the 618 here. We had the move down to the low here. And then we had some degree of a bounce. And that bounce failed to take out the 382, right? So this was, in the event, this move down here and then this, right? This was a dead cat bounce. It wasn't the beginning of a new rally to take us higher. And that was ultimately shown with then a move down, right? So again, you can sort of use it to gauge, whether or not price is going to, how strong or how good the move is, right? Is this a dead cat bounce? Is this something that's, better off to short? Or does the move have legs? Did we break through the 382? Should we expect more continuation either down or up, right? So moving on, we're going to take a look at the 0.5 now. And on that, we're actually going to go look at FTM. I have a nice wedge example that we actually traded. Going to go ahead and hide this. So the 0.5 I really like to use for a couple different things. I like to use it as a good take profit one on wedges, and also you can use them on cup and handles as well as for ranges. But for now, we'll take a look at a wedge formation here. So we have this nice wedge here. We have bearish divergences, and we had this deviation to the high of the range and came back down. And for an added bonus, by the way, we'll go ahead and draw from swing high to swing low. Price put in a small bear flag. So I actually shorted this. And if we look here, we have a lot of really nice confluences. So we have the rising wedge. We have bearish divergences, right? We had the deviation of the high. We gained acceptance back into the wedge, right? And then to top it all off, we have a bear flag at the apex of the wedge off of bearish divergence. It just all lined up really, really well. So I took the short here, and I shared this in the Discord. Okay, so there's our bear flag, take the short. And, what do we have here is then continuation of the downside, take profit one at the 0.5, which is typically your main take profit for a wedge, and then another take profit at the 618. So being that, I drew this from you can see here, the bottom of the wedge to the top of the wedge. It gives you areas of support. Okay, and knowing that these are going to be areas of support, that is a good place to set a take profit because it's where a price could potentially bounce. Okay, it's where price could potentially bounce. And two, as added confluence, let's see if I have this here. As added confluence, you have this nice channel. The bottom of the channel being here, the 618 falling right exactly on the bottom of the channel, which gives you really good confluence, right, to say, yes, this is definitely a good place to take profit, right at the bottom of the channel, for sure. So we got the 0.5, we got the bottom of the channel. On the deviation of the channel on the reclaim, you could see the strength here. It would have been a good place to probably close out upon, re-entering the channel, close the rest of your short, right? We're going to go ahead and hide that. And then two, let's just take a look. I'm honestly curious. Let's see if we had another bear flag here. If we draw, look at that. Look at that. Perfect. So look at this. Down, bear flag, short, down, bear flag. Another short opportunity, right? Two short opportunities right there. Both back testing the 382. Now, if price, again, right, just like we talked about, because we use this to class a flag, if price had broken up above here, it's no longer classed as a flag, right? So this is a really nice setup. A lot of good examples here that we could draw from. Let's see. I have let's go back to BTC. And we'll take a look. This example actually didn't really play out, but that's okay as to when I drew this out. But if you were to, some people might look at this here and say, well, this is this is a cup and handle, right? Some people might look at this and say, hey, we have a cup and handle here. Well, we can check. A cup and handle is classed when price retraces to the 0.5 on the handle. So it would be half of the depth between the swing low and the high. The halfway point being the 0.5 is where you would want to see the handle retrace to, right? And then in this case, the handle retraces here, and we see some degree of a bounce back to the top of the cup, a back test, and this is where you would then look for your long, if not at the 0.5. So here, again, this is a really good way for us to know. We see this, like let's say we see this cup ahead of time. It's a so-so cup, right? But let's say we see this cup ahead of time, right? And we see it here and we see price slowly retracing down. Well, we can say to ourselves, look, if we lose the 0.5, this is no longer a cup and handle. I'm not going to look for a bounce here, and I'm not going to look to trade this formation. We're going to cross this out, and we're going to move on to the next trade. I'm going to start looking for a new pattern or something else to trade. So it's a really good way to gauge the setup, right? You can use Fibonacci to really let yourself know, like, is this the pattern? Is it playing out as it's supposed to? And if not, okay, let's move on. We'll cross it out, move on to the next trade, right? So that's another nice one to use it for. I'm going to, we'll come back to the 0.5 because obviously you use it a lot in channels. You know what? Let's go ahead and do it. We'll dive right into it, and we'll since we're talking about the 0.5, we'll go ahead and dive into it. So we've talked a lot about channel trading. I think you guys are really gonna like this. This is a really cool this is a really cool setup with Fibonacci here. So we have this sideways channel that we've been trading for quite a while. It's been like really good. I shared this exact channel with you guys on this date, and since then we've been able to long, short, short, short here, got stopped out, short, long, short. This was obviously outside, but then of course the descending triangle, right, with the move down, another short, and then shorting here and here. We just got two shorts yesterday, and we actually just hit the mid-range right now as we speak. So channel trading is great. It's one of my it's one of my personal favorite things to trade. And what I do to give myself a little bit of an advantage is I don't just draw a sideways range, but I draw Fibonacci. So this is a Fibonacci range. I'll put the levels on here for you. Like I said, I usually don't have these on. So we'll go ahead and put these on for you so that you can see it a little bit more clearly. So typically, like this is our sideways channel, right? Okay, so you can see the 0 and the 1 is basically our regular channel. Okay. And what you can say is, well, I'm going to short price if it goes, into this sort of zone. And I'm going to long price if it goes into this zone. And what this does is it keeps you from it keeps you from thinking that price is broken out of the range. Okay, so I know in this case we did get some degree of a breakout of this and then gained reacceptance, but we'll review that in just a second. But the idea is that this would keep you from thinking that price falsely broke out of the range, right? And these are the levels. You can go ahead and copy them down and put them onto your chart. But this again is where the 0.5 comes into play, right? It's the mid-range. This is where we take profit. We short the top, we take profit at the midline, take profit at the bottom, we long the bottom, we take profit at the midline, and take profit at the top. That's how channel trading works, right? So what this does is it keeps you from falsely thinking that price is broken out of the range by using this Fibonacci setup. So if we go back to our sideways range, you might see some of these moves and think, even here, this massive breakout, you're like, you're like, oh my God, price broke out. We got to look for longs. I'm late to the move. We're going to see some continuation to the upside. And then, we gain acceptance back into the channel and here we are continuing to trade it. Or here, like these breakdowns, you can say, oh, we broke down out of the range once and twice. We're going to see lower. This is really bearish. It's time to short. Well, by doing this, it gives you sort of a zone, right? An upper and a lower zone to say, like, okay, I'll allow price to deviate this much outside of the range. Okay, price can deviate this much from the range, and I'll still look to trade it. Okay. And I know that we saw this move up, and we'll go ahead and take a look at that. Okay, so in the case of that move up there, we actually have a different channel. And that is this upwards channel, right, that we recently back tested and shorted. This was a part of our short that we took, the 1 and 2 shorts that we took yesterday that are both playing out super, super well. So we have this channel here. Now again, let's draw our Fibonacci channel. And what do we have? Well, look at this. We can say again, if price goes up into this upper zone, I'm going to short. And if price goes into this lower zone, I'm going to long. How amazing is that? How incredible is this tool, right? This channel trading tool that gives you a little bit of leeway rather than just having this channel here, right? Because again, you'll think, oh, it's a breakout, it's a breakout. This gives you a little bit more understanding of what's happening and saying, no, this is just a deviation. I actually want to long this or short this. And again, when we started to lose that, you can see here, like in losing this, if we were to, start to back test this and lose this, well, we can say this channel is lost. I do not want to long this. This is not something I want to long right now. Okay. So yeah, that's a really cool setup. And I actually used a different tool here, and I'm going to show it to you. So we have the retracement tool, right, which gives you horizontal levels. Well, there's also the channel Fibonacci tool. If you go over here and you go down to Fib channel, I'm actually going to do this a little bit easier because I want to get the exact one. So we have our upwards channel, and we can go here. I'm going to actually put my magnet tool on, go here and go to fib channel. And again, you just draw from the swing. Actually, what I did here was I drew from here. So you're going to draw from here to here, just like you normally would with doing a channel. And then you're going to extend it to the low. So it's exactly like drawing a regular channel, just like that, right? And then we can go ahead and get rid of it. And what it does is it just gives you the same Fibonacci levels, but horizontally, right? It just allows you to draw the retracement tool, but in a diagonal way, right? Instead of just horizontal, you can draw, upwards or downward trend lines with the Fibonacci as well. So that's really all that this is. Some people might get a little confused or intimidated by it. It's literally the retracement tool, but it allows you to draw diagonally rather than just horizontally. Okay, that's all that it is. I'm going to show you one more channel that was super awesome. Let's see here. We'll go to maybe our 1 hour. So it's not hard to identify that there's probably some kind of a channel here on Litecoin, right? So we go ahead and we draw that out, and we can see that we have our channel here. Let's do the upgraded version. Let's add the Fibonacci channel instead. Okay, so we'll go ahead and put that on and get rid of this. Look at how well, you could basically say, I mean, it hasn't even broken out of the deviation. I mean, a little bit here, but not enough to be too, concerned, right? So we can say we're going to long the bottom, and any deviations into this zone, and look at how well those have played out, right? And what are we doing? We're taking profit at the midline. So we'd long here, take profit at the midline, short here, take profit at the midline, so on and so long. Short here, profit at the midline, short here, profit at the midline, short here, profit at the midline. Oh, back down. Long here, profit at the midline, short here, profit at the, so on and so forth, right? You can see that every single time price has sort of reached outside of here, it's been a really good trade opportunity, and it's been easy to take, right? Versus people who are just simply trading the parallel channel might look at some of these and say, oh, this is a back test. We're actually going to look to break down here. Like, this is bearish. And then, of course, price re-enters the channel and has continuation. Again, here we get a massive move down and an hourly closure below. People might say, oh, it's time to get really bearish. This is a bearish move here. We broke out of the channel. Well, then here we are back, back inside the channel and trading up again. And, by using this tool, we could have avoided that and said, technically we're really still in the channel, right? We're just a little bit, we're in some of the deviation, right? Now, if price had broken down like this and then broken down from here, well, you don't want to long that, right? Could it give some degree of long opportunity? Maybe, but it's no longer a channel trade. It's a new setup, to look to try and trade. You'd have to do some new technical analysis, right? You're no longer trading this channel. So this is, again, a really powerful tool. This is referring to the 0.5 Fibonacci, using the mid-range here for take profits. One more I'm going to show you in regards to the 0.5, and it's a little bit of a different setup, is the, oh, we're on the wrong chart here. Here we go. Is the quarters. So again, we have our sideways channel here. Well, you can draw quarter fibs. So I'll go ahead and put this on here again so you can see the levels. What I like to do with this one is, so like, I'll show you, right? So I have this channel here. Okay, I have this nice sideways channel. Well, what I want to do is I want to clone this sideways channel, and I want to put it on top of here and say that, okay, this is a second channel, right? So if price breaks above here, I want to look at this upper channel as resistance and support and kind of trade it into this other one. Well, an easy way to do that would be to use the quarters here. So 0, 0.25, 0.5, 0.75, and then the 1. And this sort of gives you, an extension of your channel, basically, right? So we have this lower channel that we've been trading, right? Price breaks up into the upper channel. and you can say, well, this is overextended. We're reaching the 1-to-1 on that, or the 1 on that, so we can look to short this zone, back down to the bottom. Again, back up here, acted as resistance, short again. And you know what? It kind of gives you a way to gauge whether or not you should be longing or shorting. So you can make a rule for yourself and say, well, this is my general channel. I'm not going to long unless we get down to, this zone here. I'll short the upper part of the channel, the upper zone, right? In the lower channel, I'm sorry. And then if price were to break up above that, how will I know that this is a true breakout? Well, I'll know if we break out of this sort of formation here. But if we get up to here, then you can look for short opportunities, right? It's sort of a way to gauge, where are we at in the chart. If price can break up above here and have continuation, then this range is no longer relevant. We've broken out. It's time to, it's time to move on. And I'll show you an example that I've talked about and showed you guys quite a bit. It was on this chart for those of you who recall. So I had this chart drawn for like a really, really long time. I did not do anything with this chart, especially when we were down here. And it basically said, look, I'm going to hide this. I basically said, look, we're in this lower channel right now. Okay. And based on my analysis, I thought it's possible that we go down to this 14,200 level. All right. So with that in mind, I drew this Fibonacci retracement pole. And I said, all right, this is the upper range and this is the lower range. I'll continue to trade the upper range, but if price falls into the lower range, then I know the new bounds, right? Right off the bat, I know the new, area, the new bounds that we can trade, right? And again, like with this macro, macro channel that we have here, we can do the same thing. So we can take that same tool, that same setup, and we would do, go ahead and pull like this. So this gives us, again, like a nice way to gauge. It gives us sections of the chart. We can go ahead and hide this. Let's hide all this just to clear out the chart here. Again, this sort of gives us nice zones. We can say, hey, I'm not going to look for longs unless we're down here in this zone, and I'm only going to look for shorts up here in this zone unless price is to break up out above it, right? And we can see, just how nicely some of these levels were respected here in the move down, back testing the 0.5, come down to the bottom of the range, and move up to just shy of the 0.75, back down to the bottom to the 2.5, to the bottom, back to the 0.5, and you can see just how nicely respected the 0.25 was. The deviation of the range, right? You can see the 0.5 of the range, again, very well respected. And now we can see prices sort of dancing on the 0.75 as well as the top of the range. So again, that's another really nice tool for the Fibonacci retracement that I like to use. I want to just see how long we've been going on for. Okay. Yeah, we're going a little bit longer than I would like to. It's taking a little bit longer than I would like. So we'll go ahead and we'll start to wrap this up. But the most important level for me is the 0.618. Okay. So it's like I said in the beginning, when you draw some of this stuff, when you draw, like, let's say, here to here, and we go ahead and we put on the 0.5 and the 618 and the 786, I usually use these levels to gauge like how well a move is going to go. If we get a move down like this and we hit the 618, well, this is sort of like my line in the sand. If we don't bounce from here, I'm actually going to be looking lower. I think that price is looking weak. I'm not going to expect to get down to the 786 and see a bounce. Could that happen? Absolutely, that can happen. But in my eyes, it becomes a little less likely, right? So I sort of use it as a tool to gauge the strength of a move. So what I'm going to do, I'm going to use the help of my new site here, and we're going to take a look at some previous trades that I've taken. And this is one of my favorite, right? And this is a great example of how to use the 618 and also the 66 that I like to have as an added little bonus that helps create a zone. So this is oftentimes a setup that you'll see in cryptocurrency pretty often, actually. You'll see a move down like this, And people will look to long here. They'll say, oh my God, I got to get in. Or, when we get this pump here, they'll say, I missed the move. That was the bottom. I got a long here. I got a long here. And in the Discord, I'll say, don't long. Those are the early longers. They're going to get wrecked. And we'll go sideways for a time. We can see there's no real buying power here. There's no continuation. Then we get the move down. Early longers get wrecked. Okay. And then in this case too, we got the added failed auction and the trapped shorts down here. Now here is what we want to see. This is what we want to see right here, okay? This nice move up, right? Look at this. 1, 2, 3, 4, 5 green candles pushing upwards, right? Increasing volume, all right? So now this, in my eyes, is a good spot for stop loss. Okay, so we got that move up, and what am I going to do? People up here would say, oh my God, I missed the bottom, like I'm missing the move. I got to long quick before it keeps going because they think it's going to keep going parabolic forever. So they end up longing down here. Well, then what happens? Price comes down and they get wrecked. But here's what I wait for. I wait for a top to be put in, just like we did here, and then I draw a 618 from the swing low here to the swing high here. That gives us our level. And then I wait for price to come back down and test it. Price comes down and it tests the level. It holds again and again and again. And I would say, okay, I'm going to open up a long in here. I'm going to put my stop loss here. And now I'm going to look for market structure change and continuation, which is what we had. We had our low, higher low, lower, or I'm sorry, low, high, higher low, higher high, higher low, higher high, market structure continuation. That is the 618 setup. It's one that I love to use all the time. Okay, and we're not seeing a lot of examples of that in the charts right now, so I'm gonna kind of look at past examples. This is that the bear flag on FTM that we talked about earlier with the wedge trade. I have another example here. Yep. So here's another example of the 618. I drew the swing low from here to here, the 618 retracement. We had 1, 2, 3 powerful candles with, I remember, increasing volume. And of course, what do? People are thinking, oh my God, I got a long. I missed the long. That was the bottom. And then, then they're underwater on the retracement after longing the high. Well, instead, what do? We draw from here, the swing low to the swing high. We get the 618 zone. We wait for price to retrace and we see if it holds. Okay, if it holds, we open a long. We can open up another long with our stop loss below here, and then we have market structure change and continuation, right? Which would give us another really great trade. And sometimes we can see, like this is another example. This is a bad example of when you would want a long. So here, right, this is the wick down, right? We're not seeing that continuation, and then price is just slowly falling to the 618, kind of holding it and then breaks down, right? That's not what we want to see. We want to see this really nice reaction, this bounce just like this, and then back test the 618, right? We're not looking at this to long, we're looking at this to long, okay? And we have here another example. This is actually the 17.5K low. I think I have it somewhere in here. This is another really nice wedge example, right? We had bearish divergences nearing the apex of the wedge. We broke down the 0.5, take profit, the 618, take profit, and then the 886 was my final take profit on this, which we bounced from, to the dollar here on this move up. Let's see. And when I launch this site, guys, you're welcome to take a look at these. These are all available online for you guys if you want to take a look. I have these. Where is it? I could have swore I had it on here. Here it is right here. This is the 17.5K low. So again, here we had that bounce. A lot of people would hit this and think, oh my God, I missed it because it's pumping upwards now. And then they end up getting wrecked on continuation of the downside. So here we have that nice move down. We have these really strong candles, right, with high volume. And then we get our retracement to the 618. So here we can start looking to long with our stop loss below here. And then what happens? We actually have a deviation of the 618. So when price breaks down here and we get to the 786, which is this blue line here, that's where you'd be saying, oh God, I don't know if this is actually going to work. Okay, I'm going to hold my stop loss here, and I'm going to hold my my position, but I don't know if that this is going to work here. And this is where this is where you would have wanted to add more. Price reclaims the 618 right after this deviation here and has some market structure change. You would have wanted to add more here again on the 618 for then, you know, the rest of the move up that we know eventually this led to 25K, right? So it was a really, really nice move to the upside. Right, so we'll head back to our charts. Let's see what we have left. You know, so I think that may be a good place to end it. We covered flags, we covered cup and handle channels, and wedges, as well as the 618. So basically covering, you know, the 382 and its uses, right? If an asset is very bullish, you want to see it bounce off the 382 for a move up. Okay? If an asset is really bullish, you want to see the 382 hold for then market structure continuation. And what do we call that? We call it a bull flag. Okay? If we're trading a channel, you know, some degree of a sideways channel here, we'll go ahead and put on, you know, if we're trading a sideways channel, we're going to want to see, you know, our take profits be at the 0.5, right? Take profits at the 0.5. Same for, you know, a wedge, right? We're going to look for our take profit at the 0.5 as our primary for a rising or a falling wedge, right? The 0.5 is a really, really nice zone for take profits on channels, wedges. We also use it for, what did we talk about was the cup and handle here. Go ahead and hide this. That if we want to class this as a proper cup and handle, that we would want to see the retracement to the 0.5 level, right? And in this case, we know this is no longer a cup and handle because we broke below the 0.5, right? We would have wanted to see a bounce here and then continuation to the upside. So those are some use cases for the 0.5 in that. And then, of course, the last one was the 618 that we talked about with that setup, right? Seeing the 618 back tested. Seeing it back tested, right? It's a really, really key level. And I'm going to end it with this, is just to say, I'm going to go ahead and redraw this, put our default on. I'm going to go ahead and add the prices and levels. Again, I just want to reiterate, okay? If an asset is bullish, let's actually draw it from let's just draw it from here because that's kind of when the impulse started. If an asset is bullish, you want to see it drop down to this 382 and bounce from there with continuation. And what would we class that as is a bull flag, okay? If we get down to the 0.5, okay, not so bad. With some added confluence, that's another great zone to bounce from. If we get to the 618, this to me is more often than not where I'll actually wait to see price reach for then a bounce, right? Just like we had talked about on some of these lows here, right? And putting in these lows. I want to see a good reaction, a move up, a back test of the 618. I'm not waiting for the 0.3, the 0.382, the 0.5. I'm looking at the 618, and the reason being is because it is such a key level in Fibonacci. Okay, it is very, very, very key in Fibonacci. Now, if price were to break down below the 618, I'm not going to hold my breath for a bounce on the 786 or the 886. Honestly, I'm going to be looking for possibility of putting in a little bit lower or putting in some degree of a range below the 618. So that's sort of how I use Fibonacci with patterns and how to gauge the strength of a move, right? Or kind of how can we manage our expectations of a move, okay? So I hope you guys found that useful. We're going to have a lot more continuation with this, with Fibonacci's. We're going to go through the other Fibonacci tools, what I use them for. They're super, 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 super valuable. We are also going to talk about how Fibonacci is used in Elliott wave for, corrective waves and retracements for continuation. And I'm also going to talk about harmonics in the future. And when we dive into harmonics, these two levels here are going to become very, very, very key. And in fact, I know what I said earlier, how I said, well, I would kind of gauge if you lose the 618 that, likely will stay below here or maybe look at new lows. That is often the case. But if you do have a harmonic as added confluence on your chart, the 786 and the 886 all of a sudden become very unlikely, or all of a sudden very likely reversal zones. Okay, and that's something that we'll talk about in the future because that's a very advanced tool, and we have some other things that we have to cover until then. Well, taking a look here, I don't see that we have any questions. I'm going to go ahead and end the stream there. I tried to keep it as short as possible, but we did run for about an hour there. So if you guys do have any questions and I just happen to miss them, you're waiting until the end, feel free to ask in the Discord and I'll go ahead and answer them. Otherwise, guys, enjoy the rest of your day, and we'll see you in the Discord.